Hey everybody, this is Patrick Sugup with Sugup Real Estate Services. Today I've got with me James Wedding of First Bank. We came to know each other probably about 5-7 years ago, and doing some deals together on the lending side of things and business side of things. A lot of my business relationships have become personal friends, and I'm honored to be able to call James a business relationship and a friend. But ultimately, I wanted to bring James on here. We're going to talk today about some lending interest rates. I personally had some bad experience on my first deal, and I just really didn't understand it. And ultimately, hopefully, this helps you when you come across your first property that you purchase.
Yeah, thanks, Patrick. I appreciate you having me, and thanks so much for the kind words. It's been so great getting to know you both personally and professionally. And a little bit about myself. I was born and raised in Fort Collins, so lucky enough to stay around here. Graduated from CSU 6 years ago and started directly at First Bank. And I have kind of a unique role at First Bank. Not only do we do mortgages, but we'll handle all your banking needs. We'll handle all your lending needs as well. So it's such a unique value proposition to be able to kind of be a one-stop shop for our customers.
I remember one of my first deals as a real estate agent. I remember sitting at my first real estate transaction, like practice on myself on a lot of these transactions. Yeah. I don't know how you felt when you did that first deal. Did you?
It's a first-time home buyer. I always set up the day before closing or 2 days before closing for just us to let's review all of the closing documents, and you can ask me questions in a safe environment.
That's one of the things that I push a lot of my clients to, do is, you have options these days. You could go online and you can get a quick rate from Quicken Loans or Rocket Mortgage, but what you're not going to get is that personal touch that you can supply them. And
yeah, absolutely.
Talking about you felt like in your 6 years of experience, this is the busiest you've ever seen it. And interest rates are driving that. But, how are you guys seeing that on your side of things?
For the past 3 years, I've said this is the lowest we're ever going to see rates. That bar seems to get lower, or that, we'll get to, sub 3 mortgages for a week, sub 3%. I could never imagine that was going to happen again this year. I think that we're probably going to be in this low rate environment to keep, the economy in a place where it can continue to recover, especially with all the uncertainty, right?
I had done a refinance on my personal home about 18 months ago, and then I just refinanced again like 4 months ago because I went from, what was that, like I think a 4.5 on my personal home 18 months ago, and I was happy with it. Honestly, I truly was. I was like, I'm good with this. And then it went to 3%. And I even jumped the gun a little bit on that. I, could have waited an additional month and got to 2.75, 2.8%, and
it's crazy. And you get so greedy, right? You're at 3%. You're like, man, if I just could have made it in the 2s, the high 2s, that's just so nominal on your payment and the interest you pay. But just that psychology, right? To be in the 2s on a 30-year fixed loan.
It's crazy. I mean, it truly is what's driving affordability right now as a buyer. Yeah. I just did a quick example on last week's biweekly, and I looked at 2 different homes in kind of the Meadowlark subdivision. And truly, you could buy a house in that area, a $400,000 house, put $20,000 down, pay PMI, and your PITI plus PMI would be less than the house that you could rent in that same neighborhood.
Yeah, absolutely.
Yeah. Yeah. Well, hey, I've got a few questions for you. I wanted to jump into some kind of questions that I think individuals would love to know, and be educated on, and then also jump into a closing disclosure. What is APR and how is that calculated comparatively to your interest rate?
APR is kind of nice to compare apples to apples. So the term annual percentage rate, it refers to the annual interest charged to borrowers or paid to the investors in addition to all of your closing costs and expressed over the life of the loan.
How much could that fluctuate? Like, let's say the interest rate is 3%. How much could that fluctuate? Did it go from 3% to 3.5%, or is it really going to be like maybe a 0.5% to 1.5% difference. What's like a standard range?
I'd say normally 25 basis points, so 0.25%, depending on if you want to have your par rate. And when I say par, that's paying no points versus if you want to buy it down. So pay any origination points to get a lower rate, which maybe makes sense if you have a longer term horizon, right? So that's going to be the main thing that makes it fluctuate. But you'd have to pay a pretty significant amount of points or have a pretty significant amount of closing costs to have that much of a difference in your APR. Sometimes on FHA loans, you might see that because they have that upfront funding fee, which can skew the APR a little bit more. But I'd say on just a traditional conventional loan, probably 25 basis points is the most you're going to see that fluctuate.
Is that what you would obviously then focus on as a retail borrower? Not the interest rate, but cut to the chase. What would the APR be? And
they should be able to provide you an APR up front. It kind of depends. We take a stance where we have a little bit more of a conservative APR, so we have a little bit higher title costs estimated in there, especially the third party costs that we can't control. We want to make sure we put in a good buffer. Other lenders may be a little bit more aggressive, so you may not have the most accurate APR up front. So I don't think a lot of people think about the service after closing. So a lot of lenders, they sell your servicing rights. So definitely make sure you ask your lender when you're shopping with them, like, hey, do you retain servicing rights on this? And so what that means is they're going to be the ones sending out your mortgage statement each month. If you have questions, you can call them directly. If you have questions, especially when it comes to balancing your escrow account once a year, it's really nice to be able to pick up the phone, not have to wait on hold, but know who you're calling, right? So if you go through us, being able to just call me if we did the mortgage together, we can go through that. That's almost hard to put a value on, right?
Sure.
And not just how to get to closing, but this is a 30-year loan, right? So how are we going to handle the service after that too? So I like thinking of it not as a 30-day closing, but as a 30-year relationship that we're going into, right?
Yeah, I think you're spot on. And I think one of the things that we've been basically taken for granted in my short career, which was kind of began in 2009 and 10, is I've only experienced really a strong real estate market, and I think. Yeah. If and when or the time comes that maybe there's some softening or an actual dip or recession or depression as far as affecting the housing market, I think at that point you'd really want to have that personal touch rather than essentially a cold-hearted business bank that you've never seen or heard, or a servicer that's you can't talk to, can't negotiate with. I think we've gotten used to such good times that like somebody like yourself really, has shined throughout this entire time in your career, how well you've done, your relationships you've built, how good of a person, a reputation that you have. But also when bad times come, that's, I think, when you guys could absolutely shine and really work with your borrowers and, make it work for all parties involved.
Absolutely. Yeah, that personal touch and that relationship is what we pride ourselves on. And like you said, I think in more trying economic times, you get to prove that out more than you do in the prosperous times, right?
Right. We were just talking about how kind of maybe greedy I was even being, when I got a 3, but I saw the 2.75% interest rate there, and I could have bought it down. And I think I did buy it down a quarter, or an eighth of a point. How often are you talking with your borrowers about buying down points, and what does that mean, and how often, if ever, are you suggesting that for them?
Yeah, so one of the first conversations I have with my borrowers is this your forever home, or is this your for the next 10 years home, right? So what's your time horizon? With any investment, it's really important to determine that. And maybe they're only going to live in the house for 10 years, but they want to turn it into a rental, right? So, the paying points can make sense. And I think you can kind of get paralysis by analysis if you say, well, instead of paying points, if I were to put this in an investment and have compound interest, if it's within a year or two, I think that could make a lot of sense. But a lot of times those break evens are 5 and 7 years out, and it makes more sense to have just put that in a different earning asset, right?
Right. And I would say I'm probably guilty of this as well. When I'm putting out such a big, for lack of a better word, nut at the very beginning, it's like, all right, what's another $3,000 to lower my monthly payment by $75? But in reality, it's, well, shoot, I just refinanced after, like I said, basically 18 months. And you can bet your, bottom dollar that I didn't recoup those closing costs in that short time period.
Yeah, is get the credit towards closing costs a little bit higher rate. It's still a great, low all-time rate. Mm-hmm. But then you don't have that large sunk upfront cost that you can never get back.
Right. Absolutely. This is a sample closing disclosure that kind of walks you through, origination charges, service borrower, prepaid expenses. How much are these lining up with a settlement statement of a title company, and how different is the verbiage, if any?
The verbiage is pretty similar. It's just going to break it down into different categories. When you first apply, you're going to get your initial loan estimate. It's going to look similar to this, which I think breaks it out into a more palatable form, right? So on the first page of the closing disclosure, you're going to see, okay, this is the cash I need for closing.
What type of pushback can a borrower give to a lender?
It's just a flat fee, because everything that we do and every fee that we charge is covered under the umbrella of fair lending. We kind of put that one price in front of you, and it is what it is, that price. And so we competitively price it so that it's fair for all borrowers and just not those that may have superior negotiating skills. And
I was working with a buyer who just, ultimately he shopped everything, and I think, super savvy buyer, and he does a really good job of shopping lenders. And I mean, he will put them up against each other. And when his closing costs came in, I just was dumbfounded about how little he was out of pocket on them. What, in your opinion, let's say on a $400,000 loan, somebody's going to come in and put 20% down, and their credit score is 745. What could you see potentially as is a difference of closing costs for that borrower?
You're basically going to have flat fees of about $2,700, depending on what lender you're going with. But so that's going to encompass your appraisal, your title costs, lender processing fees, recording fees. Yeah, and I think shopping from lender to lender, I think you can kind of shave that APR down as much as you want. And well, I think it's okay to be more aggressive shopping on a refinance, but boy, on a purchase, you need to be going with someone who's reliable and can get you to that closing table, right? You don't want your earnest money at risk or anything of that nature. Yeah. I think making sure you're with a lender that gets you a quick loan approval and gets you to the table is so important.
The last couple of things I wanted to touch on with you is prepaids. A big portion of the closing costs are prepaid expenses. Tell a borrower as far as, why am I needing to prepay these things, and is it going to future expenses, and why is that such a big deal?
Like having your insurance paid upfront in a year, that's something that a lot of borrowers are surprised by. They don't realize that they have the upfront premium, right, when they purchase a new property for their insurance. But on top of that, the lender is escrowing for some insurance. So just doing as much as you can do to prepare your buyer that they're going to have both of those costs at the closing table. Oh, totally. And the way I always explain it to my borrowers that I work with is, you don't want an exciting edge of your seat loan process, right? You want it to be so predictable and easy it's almost boring. You want your accountant, your doctor, and your loan officer to be so predictable it's boring in your life, right? You don't want to be surprised at every turn. So my job is to prepare the buyers and the borrowers at every step of the process, right? To make it so predictable and easy, they're almost bored by it. So that's always my goal when I set it out.